They say there is a secret to becoming rich, but no, it's not hidden in a treasure map or buried deep in the mountains guarded by dragons. It's actually hiding in plain sight, whispered by a man who didn't flash Ferraris or lived in a golden castle, but still he quietly helped millions to grow their wealth, and his name is John Bogle. And I'm not here to sell you some get-rich-quick magic potion. Instead, I'll share 4 simple rules from Mr. Bogle that could actually help you grow your money over time. And the best part is, you don't need a PhD or a fancy investing degree to follow these rules. But before we dive in, if you're into growing your money without selling your soul or buying a $1,000 crypto success course, hit the subscribe button, because every time someone subscribes, a lost dollar finds its way back into someone's savings account. Probably. Okay, not really, but you get the idea. Now, wait a minute. Who is John Bogle? Well, John Clifton Bogle, or often known as Jack Bogle, was an American investor. He was a business legend and the founder of the Vanguard Group. Yeah, the same Vanguard that's now the second largest and arguably the most respected investment management company on the planet Earth right now. Why is he such a big deal? Well, they don't call him father of index investing for nothing. He completely changed how regular folks like you and me invest in the stock market. Warren Buffett often praised Bogle's contribution and said if a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle.
Why did you want to recognize Jack Bogle?
I think Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives, they're going to have better retirements, their kids are going to inherit more money because of Jack Bogle.
And it's not just Americans who are cashing in on his genius anymore. Index funds have gone global, making investing simpler, cheaper, and way more accessible for everyone. Basically, thanks to Bogle, you don't need to be a Wall Street wizard to grow your money. You just need a little patience and maybe some snacks for the long-term ride. So rule number 1, start early. Alright, picture this. You plant a tiny tree today. It's small, it's fragile, and looks like it couldn't shade a single ant. But give it some time, a little sunshine, water, and maybe play it some relaxing jazz, cause trees love jazz, I think. And few years later, it's a full-blown shade factory. You're chilling underneath with a cold drink, living your best life. Investing works exactly the same way. The earlier you start, the more time your money has to grow. And starting tomorrow does not count, because let's be honest, tomorrow has got worse commitment issues than your friend who says, I'll be there in 5 minutes, but shows up like an hour late. So yeah, tomorrow doesn't count. Now, the magic behind this growth is compounding. Now, I know compounding sounds like a boring finance word that belongs in a textbook no one wants to read, but it's actually like a secret cheat code for wealth. Here's how it works. You earn interest on your initial investment, then you start earning interest on that interest, and eventually your money starts multiplying faster than you scarfing down cheeseburgers after leg day. It's like your money is having little baby dollars, and those baby dollars grow up and start their own families, and soon enough you've got an entire money dynasty going on. Even if you're only investing small amounts, like skipping one overpriced coffee a week, you're still giving your money a head start. The earlier you plant those seeds, the bigger your financial tree will be later on. In short, start now, because future you will either thank you from a beach chair or glare at you from a desk job you didn't want to keep. Your choice. Rule number 2, diversification. Now imagine this. You're carrying a basket full of eggs because for some reason today you are a very ambitious egg carrier. You're strolling along feeling pretty proud of your egg carrying skills, and then out of nowhere you slip on a rogue banana peel, and now you've got scrambled eggs all over the floor. That's what happens when you invest all your money in just one stock or company. You're putting all your eggs in one fragile basket, and if that stock tanks, you're left with, well, a mess. This is where diversification comes in. It's like spreading your eggs into several baskets, like stocks, bonds, real estate, gold, etc. This way, if one of your investment flops, like a sequel to a movie nobody wanted, the others can still keep your financial game strong. It's like the ultimate safety net. Think of it like this. Even Batman does not fight crime alone, because he's got Robin, Alfred, Jim Gordon. They all deserve a raise for dealing with all the chaos. You wouldn't want Batman to be out there in Gotham City with no backup, right? So why would you put all your money into one place? You have to diversify. So by diversifying, you're making sure your investments have a solid team. If one of them stumbles, the others can pick up the slack. It's the smart way to balance risk and keep your financial future looking strong, no matter what happens. So don't walk while carrying one basket filled with all your eggs. A little slip will make a huge mess. So diversify your investment and be safe. Rule number 3, keep cost low. You know what's scarier than a horror movie? Hidden fees. I'm talking about those sneaky little charges that creep up when you try to buy a concert ticket, book a flight or hotel, and when you're at the checkout page, your ticket price has almost doubled because of so many extra fees. This is exactly what happens to your investment as well. When you pay high fees for mutual funds. Every time you pay high fees on your investments, it's like someone taking a secret bite out of your sandwich. You won't notice it right away, but by the time you're hungry and you're ready to take a bite, half of your sandwich is already gone. Not the best rating, right? Most active fund managers, despite their fancy titles and sharp suits, will not consistently beat the market in the long term. When you place a bet and win, you're considered lucky, but in investment, it's called genius. While there is some truth to that, but it's not sustainable long term. If someone who understands the market movement starts winning bets every time, most of the stock traders who predict the charts, going up and down will be richer than Warren Buffett and other billionaires. But have you heard about any of the stock traders being in the richest people list? No, right? Although fund managers are still a lot more educated and informed about the stock market than those stock traders, still when you go with an active fund manager, you're paying high fees for service that's just meh at best. It's like ordering a fancy meal at a restaurant. Sometimes you get a gourmet and sometimes it's just soggy sandwich.
Sometimes may be good, sometimes may be shit.
This is why John Bogle was all about low-cost index funds. He believed in keeping more of your money to yourselves instead of handing it over to some guy in a suit who's charging you for doing the absolute bare minimum. It's like paying someone to tie your shoes when you could have just done it like in 5 seconds. Now, after all this, do you still think fund managers, active fund managers, still have the edge? Let's debate that in the comments. And next time, if you're choosing where to invest, remember to keep your fees low because those fees are the silent thieves stealing from your money, your investment portfolio without you even noticing it, and they won't even thank you. Rule number 4, avoid emotional decisions. Have you ever sold something in a panic? Like the time you thought your laptop was broken, but it was just a Windows update? And instead of staying calm and letting it finish overnight, you just rush to the store and get it repaired or just to buy another laptop, only to realize that you didn't need one at all. That's exactly how a lot of people treat investing. The market dips a little and they start selling everything faster than we line up for the latest iPhones, lock in for 24 months, financing at 8% interest, only to realize that the new phone is not all that different from the one we already have, at least not in a way that actually affects our day-to-day lives. Similarly, short-term market dips have no impact on your day-to-day life because if your goal is to invest for long-term, like saving up for your house, for your children's education, or your retirement fund so that you can just stop working as soon as possible. The secret is stay calm. Markets go up and they go down. It's part of the deal. It's just like when you're trying to lose weight. You might see some ups and downs on the scale now and then, but over the long term, if you're eating good food and staying in caloric deficit, you are going to lose weight. No matter if you're eating carbs, protein, or cocaine. That was just a joke. Don't start snorting cocaine, guys. Come on. The point is, if you've got a solid plan, do not let fear or greed take the wheel. When you let emotions drive your investment decisions, it's like handing the keys to a toddler. Nothing good is going to happen. Just remember, markets are like roller coasters. Sometimes you'll go down, but you'll always go back up if you stick to the ride. If you had to add a 5th investing rule to Bogle's list, what would it be? I'm really curious to see what you guys come up with. So drop your best ideas. And what if your brokerage like Schwab, Fidelity, or Vanguard, where you have set up your Roth IRA and 401k and you have been investing all your money and suddenly it collapsed? What would you do then? Click on this video to find out how to handle a situation exactly like that. So I'll see you there.